Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF conference. I'm here with Ted Lucas, who's head of systematic strategies of ETFs at the Hartford Funds. Great seeing you, Ted.
Thank you, Tom. Good to be here.
Well, it's big news. You and Hartford all coming together, being dedicated to the ETF space. Tell us a little bit about it.
Well, we came together just about 6 months ago, and very complementary fit between the two firms. Hartford Funds has built a wonderful business over the last 20 years. On the mutual fund side of things, working with Wellington Management, now Schroders, they were very interested in establishing the ability to deliver ETFs, so the packaging. Also interested in our systematic investment capability to have an in-house engine to develop further systematic strategies. So going very well, very complementary fit. They have great distribution, great client relationships, which is wonderful for us to be able to serve a broader base of clients.
Yeah, now we've known each other for a long time, and your systematic smart beta approach is quite unique, and I'm sure that's one of the things that Hartford saw in it. Explain how, I mean, a lot of people are talking about smart beta these days, but not all smart beta is created equal, right?
Yeah, there really is a lot of variation, and I think investors, advisors would really serve themselves and their clients well by really digging into what the strategies represent. We are, the existing 5 offerings we have would be designated multi-factor strategies, so we're trying to source return enhancement by harvesting risk premiums from factors like value, quality, momentum, size, and so forth. Now, you probably have had other people say that to you today. So these are common factors that show up in some cases single factor form strategic beta or multi-factor. But I'll suggest that there's a lot of variation in terms of the actual strategies that drive what results in the ETF. I think what's particularly useful for investors, you want to understand what factors are used, what the signals are, how they're weighted, but the portfolio characteristics that result, that show what are the aggregate exposures, how diversified is the portfolio. I think you'll see the variation there. Our distinction is we think about risk as the primary starting point for the design of every strategy. So the offensive characteristics of the strategy, what risks do we want to take to enhance returns, at the same time what risks won't be rewarded, and do we want to minimize or mitigate?
Yeah. I'll never forget, and it was a couple years ago, in your office, you were explaining the strategy, specifically as it applied to your emerging market strategy and how state-owned companies within emerging markets are a huge part of the market capitalization, but really don't deserve that much credit. And you factored that out of your strategy, which I thought was brilliant because, in fact, you don't really know or cannot always trust the numbers behind it, correct?
Yeah, I think, of course, capitalization weighted indexing is a very efficient way of investing, cost efficient, tax efficient. It's return efficient. You're going to get the market return in terms of the cap weighted universe you're covering. However, when you look at some of the distortions, if you will, in risk allocation, where whether it's countries, currencies, companies, emerging markets is a good example. You have huge concentration, just a handful of companies in certain countries, like a Samsung in South Korea. And then at the country level, 3 countries, China, South Korea, and Taiwan, represent over 50% of the exposure. It is what it is. That's how the markets have evolved, but is it risk efficient? And that's really what we've tried to sort of hang our hats on, to say that there are ways to improve risk efficiency, and in doing so, we can perhaps generate better outcomes for clients than other styles of either strategic beta or other active investing styles.
Absolutely. Well, I've already seen with this partnership, the amount of support that Hartford's put behind it. They've had a long-standing relationship with advisors. They continue to help educate advisors and offer solutions, and you're a big part of that. So I'm thrilled for all of you, and thanks for grabbing some time with me, Ted.
Thanks very much, Tom.